Hello, and a very good Thursday to everyone.
Good Thursday.
So what happened yesterday? I mean, so much up, so much down, and then so much up again in the U.S. indices.
Yeah.
What justifies it? Well, let's not waste any time. Let's just get into the report and figure out what that roller coaster was we saw on Wednesday.
Roller coaster is probably the only phrase that really does it justice.
Right.
Usually we talk about a volatile day and we mean, market moved 0.5%. Yesterday was a completely different beast.
It really was.
We're looking at a session where, high-stakes geopolitics just collided head-on with the very weird mechanical wiring of the modern stock market.
It felt a bit like watching a car crash, but in reverse.
Yeah.
I was watching the screens in the morning, and it just looked like the sky was falling. Then I go grab a sandwich, I come back, and suddenly we're in the middle of a massive rally. It gives you whiplash.
It does.
So our mission today is to slow this tape down. Let's figure out how we went from, disaster to euphoria in just a few hours. But to understand the recovery, we have to talk about the hangover first. Wednesday morning didn't happen in a vacuum.
No, it certainly did not. To get the mood on Wednesday morning, you really have to look at the wreckage from Tuesday. We were dealing with a massive Sell America trade.
Sell America. That is a heavy phrase.
It is.
What triggered that? Was it just the Greenland headline?
That was the catalyst. People are calling it the Greenland crisis or the Liberation Day aftermath. President Trump just massively escalated the situation over the U.S. purchase of Greenland.
I still can't believe we're talking about buying a landmass the size of Mexico in 2026, but okay, here we are.
It sounds like a board game.
It does.
But the stakes were very real. The market didn't care about the real estate. It cared about the leverage being used. Trump threatened 10% tariffs.
Okay.
Escalating to 25% by June on 8 NATO allies.
So the UK, France, Germany.
Yep.
All the big ones. All because they opposed the sale.
So Tuesday was a market pricing in a full-blown trade war with our oldest allies. That explains the fear.
Precisely. The Dow lost, about 870 points on Tuesday? The NASDAQ was down 2.4%. Investors were just dumping U.S. assets.
Makes sense.
But here's the thing. It wasn't just the trade war. There was another fire burning over in Asia that I think a lot of people missed.
Right. I did see some headlines about Japan. And usually Japanese bond markets are, as exciting as watching paint dry. But they were spiking.
Spiking is putting it mildly. People were calling it a massacre. And since Japan is one of the largest holders of U.S. debt, we have to pay attention.
So what happened?
Their prime minister, Sanae Takaichi, announced this massive new spending plan.
Okay, help me connect the dots here for everyone listening. Why does a spending plan in Tokyo hurt my stock portfolio in New York?
Great question. It's all about yield contagion. When Japan announces huge spending, they have to issue more bonds to pay for it.
Which drives up the interest rate on their bonds. Exactly. And if Japanese investors can suddenly get a better return at home, they stop buying our bonds. Or even worse, they start selling U.S. treasuries.
And when they stop buying our debt, our rates have to go up to attract other buyers.
You got it. So that volatility just bled right into our market. The U.S. 10-year yield pushed over 4.29%. So waking up Wednesday, you had a diplomatic crisis, a bond scare, and investors were fleeing to safety. Gold hit a record high over $4,800 an ounce.
Wow.
That was the setup. The market was incredibly fragile.
So the opening bell rings on Wednesday. Everyone's already on edge. But it wasn't all bad news, right? I seem to remember one company actually having a good morning.
Right, that was the tug of war we saw early on. There was one big corporate bright spot, United Airlines. They reported earnings that beat expectations.
Again, what is that now?
For the 14th consecutive quarter.
14 quarters. That is a serious streak.
It is, and their guidance for 2026 was incredibly strong. EPS between $12 and $14. The stock popped about 4%.
Which is a signal that, despite all the noise, the U.S. consumer is still booking flights, still taking vacations.
The service economy is alive and well.
So we have this kind of, YOLO economy where people are still traveling. But then at 10 a.m., we got to look at the real economy. And that picture was not as pretty.
Not pretty at all. This was the first gut punch of the day, pending home sales.
Yeah.
The expectation was for a small drop, maybe 0.3%.
Right.
Instead, the number just collapsed, down 9.3%.
Wait, 9.3? That's not a miss. That's a catastrophe.
It's the lowest level since the pandemic started. It just shows you, with mortgage rates stuck over 6%, the housing market is essentially frozen.
Right. Nobody wants to sell and lose their old 3% rate,
Yeah.
and nobody can afford to buy at 6%.
You've got it. So while the stock market was trying to figure out which story to believe,
The traveler or the home buyer?
the bond market decided to throw a tantrum. We need to talk about 1 p.m., the bond auction.
I heard this described as disastrous. Now, usually bond auctions are super technical, kind of boring. Why was this one a headline grabber?
I don't use the word disaster lightly, but
Yeah.
yeah, this was ugly. The Treasury was auctioning off 20-year bonds, and practically nobody showed up to buy them.
When you say nobody, I mean, someone has to buy them, right? The government always sells its debt.
Well, they got sold, but at a really steep price. There are two nerdy stats here we have to unpack because they tell you everything.
Okay, hit me.
The first is the tail.
The tail. Okay, explain this like I'm 5. What is a bond auction tail?
Okay, imagine you're selling a car. The market price says it's worth 20 grand.
Right.
But at the auction, the best bid you get is 19,000. You have to sell for less than expected. In bonds, that gap is the tail.
So it's a sign of weak demand.
Very weak. Yesterday's tail was 1.1 basis points, which is big. It means the Treasury had to offer a much higher yield just to get people to take the paper.
Okay, that makes sense. What was the second stat?
The dealer takedown. This one's even more telling. Primary dealers, the big banks, are legally required to buy whatever debt isn't sold to real investors.
They're the buyers of last resort.
They're the ones who have to eat the cookies at the bake sale if no one else buys them.
Huh, perfect analogy.
And yesterday, the dealers were forced to eat 17% of the supply.
That's a lot of cookies.
It's a very high number. It means the real money investors, they just went on strike.
And that sent shockwaves.
Huge shockwaves. The U.S. 30-year yield broke 5%, and that is exactly when stocks hit their lows for the day. S&P at 6,804. It looked like the floor was about to fall out.
So early afternoon, the mood is apocalyptic, and then the camera pans to Switzerland, to Davos.
The Davos pivot. This is the catalyst that changed everything. President Trump was at the World Economic Forum, and he had a closed-door meeting with the NATO Secretary General Mark Rutte.
And when they came out, the tone was completely different.
180 degrees. News starts breaking that they formed a framework of a future deal for Greenland. It involved missile defense, mineral rights. But here is the headline that mattered.
What was it?
Trump explicitly stated he would not use force and confirmed that the tariffs on European allies would not go into effect.
And just like that, the risk premium vanishes.
Instantly. The fear of a trade war with Europe just evaporated. The S&P 500 surged from that deep loss to close up 1.56%. NASDAQ up 1.81%, a violent repricing of risk.
Incredible how fast it moved. But, before we get into the mechanics of that rally, because I have a feeling you have some thoughts on how it moved so fast, we do have a quick message for our listeners.
If you like what you're hearing today, we invite you to subscribe to the channel, leave a like, and comment on what topics you'd like us to cover in future episodes. In the description of this deep dive, you will find a PayPal link if you'd like to support this project. Your contribution helps us keep making content like this. We don't ask for more than the price of a coffee. Thanks for your support.
Okay, we are back. So we have the why for the rally, the news from Davos. But the how is what really blew my mind. The market didn't just drift up, it exploded. You mentioned gamma squeezes and zero DTEs. Break this down for us. Why did good news cause a crazy vertical line on the chart?
You really have to get this to understand today's market. We have to talk about zero DTE options, 0 days to expiration.
Right.
In 2026, these things make up about 60% of the total volume on the S&P 500.
60%. So most of the volume is just betting on what happens today. That feels less like investing and more like a casino.
It's extremely speculative. Now, going into Wednesday, because of all that fear, a lot of traders were using a specific strategy. It's called a short iron condor.
Sounds like a kung fu move. What on earth is a short iron condor?
It's basically a bet on boredom.
A bet on boredom, I like it.
You're betting the market is going to stay in a tight range. You sell a call option above the market and a put option below it. As long as the market doesn't move too much, you make money. You are selling volatility.
Okay, I get it. Everyone was betting on things staying calm-ish, but then the Davos news hits and the market doesn't stay calm.
Not at all. And this is where the plumbing of the market really matters. When those traders sell the options, the people on the other side of the trade are the market makers, the dealers.
Okay.
So they were buying, this made them long gamma.
Okay, no jargon. What does long gamma mean in practice?
It just means the dealer acts like a shock absorber. If the market drops, they buy. If it rises, they sell. It stabilizes things. But, and this is the big aha moment, when the Davos news hit and triggered that massive spike up,
The bet on stability failed.
catastrophically.
Hmm.
As the price ripped higher, the dealers flipped. They became net short gamma at those higher prices.
I mean, what?
Meaning, to hedge their risk as the S&P climbed, their algorithms forced them to buy futures aggressively.
Wait, so the dealers are buying because the price is going up,
Mhm.
and the price is going up because the dealers are buying.
You nailed it. It's a feedback loop. That is the definition of a gamma squeeze. The buying begets more buying. Their risk models leave them no choice.
And that explains the vertical line at the end of the day. It wasn't just optimism, it was a mechanical squeeze.
Exactly. A mechanical liquidation of short volatility bets.
That's why some specific stocks move so violently, too. I saw NVIDIA swung from down 4% to closing up over 3.
NVIDIA is a prime example. The options volume there is massive. Tesla is another one. It rallied 4.3%.
Wow.
Now, Tesla also had a fundamental reason, relief that the EU wouldn't retaliate with EV tariffs. But the speed of the move, that was pure gamma.
It's like pouring gasoline on a bonfire. It's terrifying and fascinating at the same time.
That's the perfect way to describe it. It's an amplifier. Bad news, we crash faster. Good news, we melt up faster.
Now, there was one other drama playing out yesterday. Not in Davos, not on the trading floor, but in the Supreme Court. Trump versus Cook. Why did Wall Street care about this?
Because it strikes at the very heart of the Federal Reserve's independence.
Right.
To recap, President Trump tried to fire Fed Governor Lisa Cook. The stated reason was an allegation of mortgage fraud.
Which she denies.
Correct. But the market saw this as a test case. The law says a governor can only be removed for cause, but it doesn't define cause.
So if the president can fire a governor over something like this, he can effectively control the Fed. He could fire Chairman Powell if he doesn't like interest rates.
Exactly. And markets hate uncertain monetary policy. So yesterday, the Supreme Court heard oral arguments. And what trickled out was that the justices, including conservative Justice Kavanaugh, seemed very skeptical of Trump's argument.
I saw a quote from Kavanaugh. Something about this could shatter the Fed's independence.
That was the key moment. When the market heard that, there was this collective sigh of relief. It signaled the Supreme Court is likely to protect the Fed's structure.
So that helped stabilize the bond market a bit at the end of the day.
A little bit, yeah. If the Fed is safe, monetary policy is predictable. And the market loves predictable.
So let's zoom out. What a day. We start with Sell America because of Greenland and Japanese bonds. We have a bond auction that completely fails. Then Trump pivots in Davos, and the zero DTE options market turns that good news into a rocket ship.
That's the summary. A perfect storm of macro fear, diplomatic relief, and market structure mechanics.
So what does this all mean for the listener? I mean, we ended green. Is everything fine now? Can we relax?
I think we have to be very careful here. Yes, the price ended higher. But look at what's under the hood. The dashboard is flashing red.
How so?
The bond market is screaming there's a demand problem for U.S. debt. The housing market is screaming that the consumer is locked out. And the stock market's move was driven by a mechanical squeeze in options that expire in less than 24 hours.
It feels like we're skating on thin ice, but the ice is made of zero DTE options.
And here's a final thought for everyone to consider. We saw a massive rally, and everyone feels good when the arrows are green. But we essentially relied on a single politician's pivot in Switzerland to save the market. If the market is now 60% zero DTE gambling, and it's dependent on, tweets from Davos to avoid a trade war, are we actually investing in the U.S. economy anymore, or are we just riding a volatility machine?
That is a little unsettling, to be honest. But it's the question we need to be asking. We're in a market that moves faster than the news itself.
And understanding that structure, the options, the algos, is just as important as understanding earnings reports.
And with that, we reach the end of today's deep dive. We hope you liked it, that you learned something new, and that you'll join us for the next one.
Thank you very much, and we'll meet again very soon.
Remember that the PayPal link is in the description if you want to help us out.